I started the Roofing Success Series because I've been advertising in the roofing space for since August 2019, so about 6 years now. And in that time, I've noticed that every single roofing contractor believes that more leads are going to solve every single problem in their business. And a lot of the times, that's simply not the case. And so I built this specifically for people who are in that position of maybe, hey, more leads isn't going to fix their business right now, to give them the resources they need to be able to grow and scale outside of just leads. Because there's more to business than just getting more leads, right? You need to have good systems in place. You need to have good sales in place. You need to have good operations, tax strategy, making sure you're keeping as much of your money as you can, and even making sure that you're planning ahead, right? For succession planning. Because a lot of companies I see also get to the owner's 65, 70 years old, and there's no plan for sale, right? There's no way it's not set up for sale, and they can't really sell their business and they end up just retiring, right? Trying to get the business to their kids, they don't want it. And I think that's kind of the issue that we're going to talk about today. Is that correct, Will? Or
Yeah,
William, how to avoid that?
yeah, it's about what's going on in roofing right now and selling your business and why it's an interesting time for all the things, I don't know, roofing related right now.
Yeah. So super stoked to dive into that. Before I have William go in and introduce himself, just want to go through the housekeeping rules. We all have a lot going on in our day to day as business owners. There are fires that we have to put out left and right, taking care of our team, fielding customer calls, whatever stage you're at in your business, there's going to be fires that you have to put out. But today, I want to challenge y'all to do something different, because I take the time to carefully vet each of these speakers. They either come to me or I reach out to them and I do a bit of research on them, say, hey, is this somebody that I vibe with, for lack of a better term, and I think will do good by the community. And William is somebody who I think will do that. And so this hour every week is built for you to learn something new that can help you build a better, stronger, faster business. And so what I'm going to ask you all to do today is close out any other windows you have. Speaking of, I have way too many windows open over here, so let me go ahead and do that. Pull out a notepad, throw your phone in a drawer. I typically throw my phone on my office couch over here. Let's see if it lands on the floor today. No, it stayed on the couch. I'm getting better at that, right? But just kind of pay attention, right? Lock in, get the notepad out, and just be prepared to learn something new, right? And I think this session is going to be really eye-opening for you guys, because when I first learned about acquisitions, when I first learned about PE, it was something that kind of changed my mind in the way that business operates forever. And so today's guest we have, William Pauly, is an expert in kind of helping people to, I guess, exit their business, right, and understand the fundamentals of what happens when private equity enters a space. Is that correct, Will?
Yeah, that's really it. It's a lot is around education of selling through private equity and also usually around these facility services, home services. I mean, right now I'm pretty much all roofing, but in these sectors.
Yeah. And I know, I think in other industries, there's already been that consolidation has happened, right? So we could probably extract some trends from
Oh,
that.
there are a number of
But
industries. We'll run through that. There are a number of
okay.
industries.
So with that being said, do you want to give a quick intro to yourself and kind of your expertise so people have context as we go into the call?
Yeah, absolutely. And first of all, George, thank you very much for having me. Really appreciate and like what you're doing here for the community by just kind of offering knowledge and insight for folks. It's very valuable. There's almost too much information right now out there in the world, and it's the hardest thing now is figuring out what is worth paying attention to. So it's nice that you provide kind of some curated information for folks to pay attention to and learn from, which is really great.
I appreciate it. It's still a baby,
Uh,
trying to make it better every day. So thank you.
yeah. William Paul, yeah, I do. Right now, my focus is kind of really focuses on roofing M&A services advisory, really helping roofers understand what's going on in the roofing sector, and if they want to do something, do kind of pursue some sort of sale or exit, help them do that. And how I got here. So I started doing M&A close to 20 years ago. I worked for a middle market investment bank. We were selling companies kind of valued 50 to $300 million. Then I went to a private equity firm. We were buying businesses valued kind of like 50 to $300 million. MBA, another investment firm. My wife wanted to get back to the Midwest, so I joined GE Healthcare doing internal M&A there. Actually left to find a business to buy myself. I wasn't as great as all these roofers that found these things from scratch and grow them into meaningful businesses. I was trying to find something that, kids didn't want, family business. Did acquire something, but I'm not really involved day to day with it. But where it gets more interesting for this conversation is I then joined a fire safety business doing internal M&A for them. And, George mentioned there are other industries being consolidated. So this was a fire safety business that does like fire extinguishers, sprinklers, alarms, and they'd been acquired by a $2 billion private equity fund, and they were trying to grow as quickly as possible through M&A. And I was the M&A guy leading that charge. And we acquired a dozen companies in 18 months and grew the business substantially. And what I realized, and the idea was just basically grow as quickly as possible by acquiring similar businesses. And what I learned doing all that was that a lot of these business owners in these sectors are being gobbled up, and we can talk about which ones they are that have going on. They're in there more now. Most of what I was doing was education and knowledge sharing around what we were trying to accomplish, how transactions work, what a buyer views as more valuable in that industry, what they look for, again, how a transaction works. And that's mainly what I was doing. But what I realized is, like, as the buyer of that business, there's kind of a limit of what you're willing to share when you're actually trying to buy that guy's business. So you kind of share everything. And I thought it'd be more rewarding, more fulfilling to really help these business owners understand when private equity kind of attacks that industry, so they can understand the game they're playing to try and take advantage of it and make the best decisions for themselves about maybe they can hit their goals faster or a different way to hit their goals, whatever it might be. So I left in order to help small business owners, and I went kind of all in on roofing. And the idea was that by going all in on roofing, I can speak the same language as business owners, understand their business very easily. What is normal? What's not normal? What do roofing businesses typically look like? How do different ones operate? What makes a good one versus a bad one? All those things. The metrics that are normal, that I could kind of cut to the chase quickly with guys. You don't have to explain stuff to me. And then I could also understand all the buyers and all the options for them very well. Who the buyers are, what they look for, what makes them different, how they structure deals, how much they pay, what geographies they're looking at, what their size thresholds are, who's looking for retail, who's looking for insurance, who's looking for commercial, all those things. And I could kind of learn all those things to be a better resource for business owners. So that's what I did. And that's what I'm doing. That's what I've been doing. I share it online, but that's really what my focus is. And I kind of joke, like, yes, my real job is like helping people execute stuff. But what I really spend, I'd say, most of my time, if not all of my time doing, is sharing information with business owners to help them understand what's going on, how private equity works, what they're looking for, how their business might be valued and viewed, so they can make a more informed decision with what to do. Nobody makes decisions without good information. So my goal is to give them good information so they can make better decisions. And this is, look, for most people, this is a one shot. You get it selling your business, and you want to make the most of it because it's probably the most valuable thing you'll own. And you want to make sure you understand what you're getting into and how it all works. So that's really what I do. And again, a lot of this is comes from like hand experience from doing M&A for a really long time and being in some of these consolidations, and also talking to a lot of guys and hearing stories and vetting things. But that's really what I do. So
You ready for a bunch of follow-up questions?
yeah, let's do it. I mean, I can dive into some basic stuff to start with. I don't know. Everyone comes to these conversations with different levels of understanding, and I sometimes think that's even problematic to assume people are on like understand certain things, because they might understand it like through a different lens. So we can start question. I'm happy to give a little primer on like private equity and these consolidation plays, which is really the underlying theme going on right now in roofing, before we get in, if that makes sense.
Yeah, that's completely fair. I did have one
Okay.
question before that, if you're okay. That won't
Yeah, let's do it.
overlap with any of that. I was wondering, so you had entered roofing, I entered roofing as well as an advertising agency. I had done a bunch of different home services, found that to be the best industry as far as like results to dollar. Started scaling that. What is it that made you kind of hone in on roofing and specialize within this industry?
Yeah, absolutely. A couple things.
Mhm.
And this is just, so I initially I'd spent the last 18 months in fire safety. So honestly, I had a non-compete there. I wasn't allowed to stay in fire safety. So that was one reason I wasn't staying there. Besides that, I was looking for an adjacent sector or space that I thought would be relevant, that kind of had similar dynamics. I was also kind of facility commercial services where blue collar technician stuff would translate to the people I was interacting, because that's where my background had been, of like managing those teams and services focused. And I've just been, so I had a couple of industries I looked at, had some friends that had done some. Why exactly roofing? There were two or three, and I just began getting much more educated on roofing and thought, let's do it. Let's go and do this. And that's really what it came down to. No, I'd love to tell you I have some sort of family history or an uncle with the business. I just began diving down the rabbit hole of getting really smart, talking to people, getting more educated, and it just kind of snowballed and went from there.
Okay.
So, yeah, I'll start with a little primer on, like, I guess, I'll try and do it quick, like, kind of like what is private equity, and then I'll jump into like these strategies and we'll go from there. I mean, here, he told me I could share some stuff. So let me share this. I'll make it,
Jay, we'll open up a Q&A here in a bit, by the way.
yeah, I'll put this up because this is kind of private equity in general. So in general, what private equity does is they buy entire companies, they fund them usually with some significant portion of debt from a bank. They try and grow those businesses over time, and they sell them at the end. And they use all the cash flow generated every year to pay down the debt over time. So like here's a representative example to show the characteristics. I mean, so they buy a business for $80 million that does $10 million of EBITDA. They put 10% a year. They sell it for $8 million of EBITDA, but they happen to still make 3 times their money. And some business owners might look at that and say, hey, that's weird. That business grew from 80 to 130. That's like 70% growth. How did you get a growth out of that? And that's the power of leverage, where they fund part of the deals with leverage. They pay down the leverage over time. And that's kind of the model of what they do. And they hold them for 3, 4, 5, 6, sometimes 7 years to do that growth. And what you'll learn here, and you'll hear an underlying theme of, is that when you buy business and you fund it with debt, and your number one objective is to make that business worth more in the future than it is today, knowing the sustainability and predictability of that business is like the most important thing. The more predictable and sustainable that business is, the higher value they will pay for it. And like, I'll give you some extreme scenarios of like, software that's on like a recurring monthly basis with low churn rates. Obviously very, very predictable, very sustainable on, like, you see they're paying every single month. Goes for a big price. Think about, like, I'll even go back to like the crazy example from years ago. COVID testing centers. Through the roof. They were through the roof during COVID. Do you think anybody wants to own one now? No. So like, you made money in the interim, but like there was no real value in the end for these things, so nobody bought them. And that's the value of getting that predictable business, because they're being worth more in 5 years. Somebody will pay them more in 5 years for it than they're paying for right now. That's the bet they're making. And that's how they get paid. They get paid on, in this graph, these light blue bars, they put it in equity, they turn it to 120. They get paid on the performance of that. So that is what they're laser focused on doing. So that's kind of what they do in general. And then we'll skip that one. I'd say these add-on acquisitions, buy and build strategies are getting more and more popular, more and more, say, like, aggressive in what they do. You go back probably 10, 15 years, an add-on or a consolidation play might buy 7 businesses in 5 years. On this page, these are tons of examples of people buying double-digit businesses every year. Like the one I worked on, we bought a dozen companies in 18 months. I mean, here's HVAC. These are a few years old, but it's probably only gotten more heated. You could add roofing to this list also. Here's an HVAC business that bought 21 companies in 1 year.
Also HVAC companies, like they're buying up the same vertical.
Yep. Oh,
Okay.
Good point. No, good point. So these are all industries that are being consolidated or rolled up as well, or they're in some different phase of doing. HVAC, pest control, landscaping, fire safety, pool services, car washes, insurance brokerages. veterinary services, water filtration. I can give you more. Accounting practices is on there. Property restoration, tree care. What are some other ones? And this isn't, I mean, another one near and dear to a lot of roofers' heart. I mean, this is ABC Supply and SRS for the last 20 years, buying up other roofing supply businesses. And I think a new one was a QBO. The guy that bought Beacon, I think, is planning on doing probably similar to what SRS did. So it's a new strategy. And the idea of that, this is that same. So if you look at this side right here, 10 to 16, that's what this is. 10 to 16. This is the same business, same, but now we've layered on add-on acquisitions. And that business now at the end is over twice the size that it was they done organically. So it's just a faster way to get their return and generate growth. So that's really the focus of what these add-ons are doing. It takes advantage of, I don't know, what a private equity views as their differentiator and their skill set, which is finding, executing deals, and a lot of capital at their disposal. So that's what's going on in roofing. And again, I've said it a number of times. It is new. This idea is new to roofing. It is not new to private equity. It's something they've executed in a number of different industries. I will pause there.
Okay. We got some questions coming in already. I have one. Jay has one too. Um, but just want to ask real quick. So we're talking about add-on plays too. So roofing companies coming in, just to be direct with the audience that we're working in with, and buying other or buying competitors in their market to scale, as opposed to investing more into business development or advertising the sales like scale. Is that correct?
It's a little both, actually. So the idea behind it is, let's walk through an example. If you have a really successful roofing business and you want to move to Cincinnati, you've spent a lot of time building a successful, you bought a business with a very successful, strong brand in Indianapolis, and that's fantastic. And you can invest in growth there because the brand is recognizable, it's got a reputation. You will, kind of your second point, you can increase your marketing spend in Indianapolis on that known brand. And that is a key strategy. What they do is just like, here's our ROI. Let's just dump more money into it to drive growth. Now,
Okay.
if you want to end that business and say, go to Cincinnati, that brand is meaningless in Cincinnati. It means nothing there. And yeah, you could greenfield it and go start from zero and try and develop the reputation, develop the brand in Cincinnati and grow the business faster. Or you can buy a similar established brand in Cincinnati to do the same thing there. Pour money into that established brand. And that's really the idea is they would rather invest in established, proven brands than start them from scratch. Because going from zero to something is really hard, but taking something that already works and investing a lot more money into it enables them to see results faster and get a better return for their investment. They're okay, and they have the capital to kind of say, well, they don't have to start lean. They don't have to say, like, let's see if we can open this branch for $100,000 and open it lean. They're like, no, we'll dive in at $15 million and turn into 30 really quick. And they view that as a better opportunity than going in greenfield and greenfield with a new brand.
That makes sense because then they can kind of leverage the cash flow of that existing business, the brand, and then take their systems and implement it into it as well to further scale. And okay,
Correct.
so they're going into
Correct.
separate markets, not necessarily trying to roll up their market and buy up their competition.
Yeah, most people are once they once they get in a market, they're kind of sticking with the brand they have and they're investing behind their brand. Some people will do multiple brands in a market, but most of them are probably interested in kind of a brand per market. So once they have coverage in that market, they're kind of good. And they're just going to keep investing in their existing brand.
That makes sense because they don't have to rework. Like the brand presence is already there, so they're typically leveraging that so they don't have to kind of greenfield play like you were saying. Okay.
Correct.
And then I have
Correct.
one other question. I want to answer Jay's question too here in a sec before we dive into further Q&A. Let's say that I'm a roofing company owner. I don't plan to sell my business. I don't care about selling my business. And I also don't care about maybe doing add-ons, right? Or scaling any further. Why should somebody like me say that I'm that roofing contractor, care about PE, care about M&A occurring within the roofing industry.
So if you have no interest in selling, do you have interest in growing?
I think we just have an interest in growing. So sure, yeah, we have an interest in growing.
Yeah, I mean, I think what you should focus on is um, your market is going to probably get more competitive, and that means the competitors in your market are going to be better funded, more willing to invest capital for growth. And you can kind of say the market's big, who cares? But again, depending on the marketing you're doing, they may now be paying up for better salespeople.
Yeah.
They may be paying up for better office staff. They might be bidding up the cost of marketing in your market. They may take ad spots available. Like there are other things they may do that make your life more difficult. And being aware of that, and to some extent, knowing what levers you might be able to pull to compete with talent and what's going on, and just differentiate yourself. Because in the end, you're also competing for talent in that market. And if you can make the case that, you know, the culture here is unique and different because we're independently owned. We make decisions differently because we're independently owned and locally owned. That can help you compete for talent, which is big. The marketing side is tougher because that's all third party-esque, and if someone buys up all the ad spots, there's less ad spots available. But the reason it probably figuring out a different way to like position yourself in the market in order to show that you're different and unique.
Yeah. So being able to understand your competition to be able to compete against them as opposed to trying to blindly hope everything else will
Exactly.
look the same.
Exactly. And to be fair, I mean, if you have been selling no matter what, like you probably don't need to know a ton, except you're gonna have good competition now. So you gotta be better.
Yeah. Okay. Completely fair. And we got a question from the audience too. Do you mind if I pull that in?
Yeah, let's do it.
Awesome. So Jay said, other than technology adoption and institutionalization, Jay, you give me a big word there, brother. But institutionalizing processes, sorry. What is or are the best couple of things an owner can do today to prepare for a sale 3 to 5 years from now? And how long should an owner prepare for that sale ideally? Did I get that question right, Jay? I think I did. If not, let me know, Jay. But I think that's the question, Paul. Is like, what can you
Okay.
do to prepare for a sale in the next 3 to 5 years? Cool, we got it.
Yeah, I would say continue. A lot of it depends on how big this is and what your
Yeah,
business looks like. Um, some businesses by nature are just more attractive, some are already of size. If you're not big enough, it's grow to be big enough where the kind of I'd say the market really opens for roofing owners. It's probably around $1 million EBITDA.
okay.
But what I'd really say is assuming you said institutionalizing all your systems, keep doing that. But the most valuable thing you can do is continue investing in your brand and reputation in the market. Because in the end, that is the most valuable thing you will have when you go to sell and that you want to demonstrate you have. A number of other things I can talk about. It's kind of like it depends on where you are. I mean, focus in on an end market on a specific market. If you're split between residential and commercial, that can be problematic. But it's really about honing in on your business and I'd say the reputation you have out there. Other things you can do that are a little more blocking and tackling, have good data because strictly your P&L is not going to cut it. I mean, most businesses out there have a preference on buying certain types of roofing. Each buyer probably has a preference on buying a certain type of roofing company, and you need to demonstrate you are that type of company and show it in order for them to be interested. So just saying sales isn't help you. I mean, they're going to want to see what is driving your sales. Is this roofing, siding, windows, gutters? Is this insurance, retail? Like they're going to want to see all these things. So tracking your data well will be advantageous because they're going to want to see this on a historical basis. Because again, they're going to want to go 1, 2, 3 levels deeper in order to provide that information. So that's like just fundamental operational stuff you should be prepared for and making sure that's ingrained in how you guys operate.
And what are typically those data points that they should be tracking closely in order to be able to provide private equity firms or whoever's acquiring their business with the data they need?
Yeah, I mean, a lot of it's some of the stuff they do right now, which is lead generation, close rates, but then it's kind of having more detail. I'd say it's higher quality data around all projects and jobs. That's where things can get a little bit sloppy because in the end, they're like, oh, we're moving fast. It's just, we got the revenue, we got the cash coming in, but it's like they want to know where it's coming from. They want to know what it's from. And that's where it kind of begins to get a little murky around like how good is that project level data you have? Because they're going to want to see that and understand it as well. And they'll dive into employee information, sales information, close rates, all those things in your overall process. But I'd say knowing the top line, digging on the top line is where they're going to want to focus more and how you get there. Because that's what they're going to look, they're growth investors are focused on growing. So they're going to understand like what can we do to grow here and what has been working so they can usually add to it.
Okay. And so there's front end metrics for sales, understanding what lead gen looks like, cost, conversion to appointment, conversion to sale. And then also on the project side, you're saying project level data. Would that be kind of like what the cost of goods sold are that typically go into a project, and then what the average margin is, or
Yeah, that's information. So that's it. I'd also even say kind of what you're selling. So again, going back to is this roofing, siding, gutters? Is this a retail job? Is this an insurance job? How are the like this what was supplemented? Like they're understanding where this is all coming from.
Mhm.
Because buyers care which one it is and how is that rotated. So for a lot of people that matters. Because they want that next level down of how are these jobs coming in? Or is this a lot of door knocking stuff? Is this word of mouth? Is this from people calling, like whatever it might be? That's the level down they're gonna want to understand because that's when they learn about that, how they feel like they really understand the business better, what they can do with it, which is what
Okay. Are there any lead sources that present as like problematic when purchasing a company? Maybe something that may not be predictable, controllable. Like, is there anything on the front end that it just shows, okay, maybe this business won't be scalable for us, or is it typically, hey, as long as they're generating revenue, they have good EBITDA, like we're happy with that, and they have good conversion.
I think this is where like storm markets come up. Is this like a 1 in a 20 year you just went through, and is that sustainable?
Yeah.
Is a big one. Look, there's some people out there where they look at kind of like storm door knocking as it's okay. That's the hardest one because in the end, when this business gets sold, is probably still going to be a part owner in that business, but they're going to get a decent chunk of liquidity. And if that business owner is super, super essential, like keeping that team together and kind of making sure that they're executing on a daily basis, knocking doors, pounding the pavement, doing all those things. If he's not as focused on maintaining that cohesiveness post sale, the business probably won't perform as well and isn't worth as much. So that's why when they see a business driven by the reputation, inbound leads, marketing, all those things, that can get transferred much more easily.
Okay.
And that is therefore more valuable because we're more confident we can transfer that lead generation machine to the next guy. And it's also more investable, where you can invest more in the marketing and branding to drive growth that way. If it's strictly, I mean, the most extreme examples like storm chasing is if the owner of that business is no longer holding that team together because he has less incentive to do that post sale, the business probably isn't worth as much. And that's just a reality. And that's why those businesses aren't worth as much. So I'd probably say door knocking can be the gray area, but it depends also on the type of door knocking they're doing and what the sales pitch is.
Okay. So kind of like storm markets where you're relying 100% on acts of God to provide business for you is where it becomes a little bit more problematic to sell because it's, hey, we can't predict that we're getting another storm, right? It could be, like you were saying, once in a 20-year storm. Is that
Yeah, I think it's okay. I mean, they'll do analysis on that. Like,
okay?
for example, if you have a hurricane come through Florida and you try and sell your business on like a business that just quadrupled, like it's
Yeah.
not that hard to figure out. And other storm markets that are more consistent and steady. Texas, Dallas gets a lot of steady storms. There's like the hail belt that gets a lot of steady storms. But there's some areas where, I mean, I've seen the data too. There are a couple markets I think of like, you know, like I think Denver a few years ago had like one of the biggest storms they had in a really long time, and they'll overlap hail numbers with revenue to be like, all right, this has been driven by the underlying storm than the business. Now, there are also ways around this where if you can show that, yeah, we had a hailstorm, but I also doubled my sales. If I doubled my sales, if I show that I invested in marketing and had new systems in place, you can show there are fundamental underlying reasons the business performed better this year. If you go through and you look and the sales guys are now selling twice what they used to, that's a little bit more problematic because that's going to revert back to whatever is kind of what's happening after that storm in the future. And again, they're buying the future. So they're gonna be very focused on. So it depends on what has been the underlying driver of the performance.
Okay, that makes sense. And so it's just kind of making sure that, hey, what we're doing now is something that'll actually happen in the future. And if it is, like Tampa had two hurricanes hit in a row last year, right? There's
Yeah, it's
spikes.
what we're doing is sustainable into the future. And again, that comes back to that term here. That term I mentioned a lot. They're buying, they want to buy something predictable and sustainable. So what they're going to look at what is the predictable and sustainable future of this business, which may not necessarily be what it was this year. Because if you're selling on some sort of hurricane or major storm event, they're going to go back further and say, all right, what was it before this? What's normal? Because this year wasn't necessarily normal. So it's about understanding those things that buyers see that and factor that in.
And just knowing as you go for a sale, like, hey, this could be affect the sale price, right? You maybe won't get 4x EBITDA of what this past year because it was four times what you typically did, and a storm caused that. Uh,
Yeah, or it's really talking them to a case for like the business grew a lot from a storm, but look, there are fundamental differences around what's going on with the business to drive that. We have more salespeople. We've done better training. Like if you can show that we've just have more guys out there and better system for what we're doing. Like, yeah, there was a storm this year similar to last year, but we had more sales guys and we've grown the business, and that's what drove our growth, not just some
okay, that makes sense because then we justify, hey, this is why this
yeah, you're showing that like there
happened.
are real fundamental reasons behind our performance, not some exogenous factor that can't be repeated in the future, or it doesn't repeat normally in the future. But it's like, no. We executed things on our end that changed our year, and you want to that's what you want to make the like we controlled that, and we did things different to be a better business.
Okay, so I guess that's why it's important to track that data very accurately so that you can prove that instead of just hoping that you can. Okay, that makes sense.
Well, for
And
those, I mean, for tracking, it's really about, as I said, the different products, but also like what is retail versus insurance, tracking all that stuff in a historically in the same way. Because you might have a baseline of retail, then storm comes, and it's like, no, but this is our baseline stuff that's always there. So that's, and then we have upside and gravy to that. So it's about focusing on those things so that the good picture of what your business actually is.
okay, and one thing you had mentioned a little bit earlier that's sticking in my brain, I can't get it out, is having commercial and residential can be problematic. I know a few guys who actually have that, right? They have a commercial division and a residential division. What is it that makes it to the sale?
Good question. So let me start with some basics that in the end, well, I'll start with some basics about, and then we'll lead to kind of other stuff. So as someone much closer to roofing, people in the industry, like I've come to appreciate that they're fairly different businesses. They're more different than people might think at first blush. And the sales process is different. One of them is a B2C sale process. One is a B2B sales process. So one of them is very much a lead generation game, and one of them is a relationship-based game. And usually, sometimes you just go to their website and see which website is flashier and more up to date and has more whistles than the other one. The technician model is usually different. You have most, not all, I'd say it's more common in the commercial world to have W-2 technicians on roofs actually doing the work. In the residential side, it's fairly market to be 1099 labor. So they're different, as I said, different sales process, different lead generation model, and different kind of employment and HR model, or like, I guess, operational model for the employees. So they're kind of different. And then, so I would imagine if you're an owner or a roofing owner, you have different processes for all those things. You're going to have multiple sales systems. You're going to have different lead generation paths. You're going to have a different HR model based on those different things. But even more so from a buyer's perspective, most buyers, I'm trying to think of all, I'd say pretty much all buyers, they have a strategy of what they're trying to build. And most, if not all, are trying to build a residential or commercial, not both. So they're looking for what they're looking for, and that's what they value, and they're not going to value the other side as much. And it just means you won't get full value because they just won't value the other side as much as the value of the side they want.
They see it as like an excess fat, basically.
Yeah, or it's just like that's a non-core piece of the business for me. Part of that's also because like as a larger business, multiple roofing businesses, they may be trying to have a more streamlined sales process. They might try to have their marketing might be geared around the lead generation model versus the relationship partnership based stuff. Their in-house operations might be geared around W-2 labor versus 1099. So like they want to simplify it as well. And they would rather choose one or the other. So they're not going to value the other one as much. And even so, if you have a business, like here's an example. If you're a 50-50 business, if you do it, I would recommend, and keep in mind, this is a finance M&A guy giving this recommendation, not someone in the trenches building a roofing business. If you can take them to market under different brands, that's probably worthwhile. Even if the back office is somewhat similar, if the outward facing market is different brands, that's probably beneficial. Because if you think about it, if you have a business that's 50-50, 50 residential, 50 commercial, if you sell the residential side, you've taken that brand because that is a very, very valuable thing. In which case, your commercial side has to get rebranded anyway if you want to keep it. So you're kind of, if you do actually sell it and they take the whole thing, great. If they don't and they say, can I just take one part? They're probably going to want the brand. They're on the residential side, they're definitely going to want the brand to go with it. And in which case, you're going to have to rebrand the commercial anyway. So you might reduce some headaches for yourself by considering rebranding them or going to market on different brands right now, which would make it easier in the future.
Okay, so kind of splitting up that brand, half residential or different brand for residential and commercial. So that way, if you do sell and they only want the residential piece, you can split that out easily as opposed to having to restart your commercial brand all over again.
Correct. And then you can also make the case it's more of a pure play business when you do talk to someone instead of it.
Okay.
And you can have some back end overlapping, but the outward facing stuff can be different.
What about like accounting metrics too, like keeping two separate sets of books, one for residential, one for commercial? Or
Good question. This is where it gets a little tricky. I mean, because a business owner is probably not going to want too much redundant stuff back end just for the purpose of this in the future. I'd say as long as you can identify what's allocated to each one is probably enough. But again, this is honestly where it comes down to like, it sounds bad. How attractive is your business and how
yeah,
bad do they want it? I mean, if it's like on the margin, like I'll give an example. If it's like on the margin, we're kind of wondering, is this big enough for us to be in it for an acquisition for us? And then you layer on complexity of a carve out and starting your own books, you might just say like, this feels like a lot of work. But if this is a huge business down the middle of what they want, they're like, it's worth it. We'll do it. So it kind of varies based on some other factors of how compelling is the opportunity for the buyer.
that's interesting. I didn't know that about like commercial and residential.
Yeah.
I'm gonna send this video to some of my guys clients that aren't on here right now. I'll be like, hey, I know you want to sell. Check this
Yeah.
out.
Yeah.
Okay, cool. And by the way, guys, just want to take a quick pause. If you guys have any questions, feel free to either drop them in the Q&A or the chat, or if you want to pop in and ask your question live, you can do that too. Just drop it in, and when you ask your question, just say, "How I want to ask this live." We'll pull you in. You don't need to be shy. But with that being said, if you guys want to ask it live, feel free to jump in too to say hey, I want to ask it live, and we'll bring you in. But we do have a few questions in the chat, and I just looked down at the clock. The last time I looked, it was 5 o'clock. It's 5:46 right now. So I'm having fun. Time's kind of flying for me. Appreciate you being on here. But with that being said, we got an anonymous attendee. Guys, don't be shy. You can share your name if you want to ask anonymous. That's fine too. So you had talked about good versus bad roofing businesses, right? Being able to understand that by singling out the roofing industry and focusing on that. And this person's asking, what size roofing company is P really attracted to, and what are the multiples that you're seeing, William?
Yeah, I'm gonna give you I'll give you a partial. It's first of all, it varies a lot. So I'd say you said what size? I'd say the market begins to open at $1 million EBITDA. Some people still want a minimum of, some buyers are still focused on like a minimum of 2 million of EBITDA. So it varies by buyer, but I'd say the market opens up around $1 million of EBITDA. And I'd say if your insurance, it might be a little bit higher than that. And if your retail be around that or just a little bit lower, it kind of varies. Again, everything's a little gray. But around $1 million EBITDA is where things really begin opening up. Multiples vary. It's going to vary. I'll tell you the things they vary on a number of factors. The biggest ones are size of business, retail versus insurance. Those are probably the biggest drivers of what's different. And then you kind of location, lead generation model, marketing, all kinds of stuff. Marketing, reputation, all those things. And then on the commercial side, it's really driven by what's again, mainly re-roof, I guess I should have said, and new construction. On the commercial side, it's much more around still maybe 1 million plus, maybe pushing 2 million of EBITDA on the commercial side. And then non-new construction, the more repair service work you have, the better. You know, a lot, re-roofs, the big dollar value stuff. But it really varies. And it scales as you get bigger. I don't want like too big of multiple because they're kind of, and there are enough multiples getting thrown around that it can become problematic. I'm more than happy to share with folks if I learn more of the situation, share stuff. That's not a problem. It's just dangerous to give generalities and throw stuff out there.
Completely fair. I do the same thing with marketing, right? Depends on market, depends on a lot of factors, right?
Yeah.
Like our clients who have stronger brands typically get lower cost per lead, higher conversion, no appointment, and sale. But cool. So with that, you talk about for those, I don't know how familiar people are with their actual back end metrics. For those that aren't familiar with revenue versus EBITDA, would you mind breaking that down?
Yeah. Yeah, sure. So that's a good question. So revenue is the more basic around, I mean, a buyer's going to look at this through GAAP accounting, which is accrual based. So, which is not cash based is just when the cash hits your bank account. Accrual is like, we completed this job, therefore we have the revenue, all the expenses associated with it. So they're going to accrual based. But it's really, revenue is a little easier. It's about jobs completed in the last 12 months. And this is different than jobs signed. That's been a problem for folks as well before. And then EBITDA this is, I would say, the fully burdened earnings of the business. And so revenue minus materials, minus labor, minus commissions, minus overhead, even you need to do minus depreciation. But the EBITDA would be that earnings number, and then you add back your depreciation. It's kind of like your annual cash flow from the business before buying new trucks and stuff. And the couple areas I've seen in roofing where this can be gray for folks is one, some folks own a building and the building may charge them rent, may charge them above market rent, no rent. So it needs to factor in a normalized rent for the business in order to get kind of like an arm. Because I assume, well, when you sell your business, you're not going to keep letting it operate there for free. So you're going to want that being just a market-based transaction. Yeah. Also, some owners for tax reasons, take varying salaries, and your EBITDA should factor in what is a market-based or normalized salary for you as the owner. Because you might take a salary of 0 right now, and that's great for tax reasons. But when you sell your business, you're not going to keep working for free every day. I mean, you'll have equity you're working for, but you're not going to just work for a salary zero. So you're going to want to factor in some sort of normalized amount. And then EBITDA is after factoring in those items, what is left at the end. And that's the metric that a lot of buyers use to as kind of the value your business, the earnings metric, benchmark the value your business.
Okay. And so they're adding back, like, if you're not paying yourself a salary and it would be $100,000 a year for somebody to operate a roofing business, they would add that back against EBITDA, which would bring it down.
Correct. They'll add that back in. They'll add in a facility expense. They'll add in normalized stuff. In the same token, if you have maybe family members helping the business that are getting paid in the business and aren't really active, you have other things you're doing that you run through the business, like you can take those things out. You need to just be able to identify them, but it's very normal to take those things out and say, hey, these expenses are business related, and that's fine. But the main thing is they're gonna want to look at this as a normalized business run, kind of with all the appropriate level expenses
Yeah.
for the
What
people
will it
operating it.
predictably look like after we purchase this?
Predictable. I like it. There you go.
I'm learning. Awesome. And we got a few more questions in the chat here. I do want to open it up for you at the end. We're running short on time. Thank you for making this a fun session that went by. 52 minutes felt like five. Um, but with that being said, we got two more questions here. We got another like M&A guy in here that has a question. Then another person asked anonymously.
Where are we in
So
the
it's kind
cycle? I think I
yeah,
see
do you
that
see
one.
that?
Yeah, I see it.
Okay.
Where are we in the cycle? It's interesting. I would say we are early in the cycle. But it's happened much for roofing than it's happened, I think, in other industries.
Interesting.
And part of that, I think, has been driven by the size of opportunity that roofing businesses can get bigger faster. So they can be, as they call, chunky. And they can get enamored by build a big business fast. So I think it's early. I think it's also unique right now in the roofing sector. Or one thing that's unique to some of the other roll-ups, we mentioned this earlier, George, like once a buyer kind of like buys in a market, they're kind of good. They're kind of looking at having brands per market. And that's where like, yeah, we're early in the roll-up, but if every single buyer is in your market already, like they may not be as interested in you because they're already in that market. They've kind of already picked their horse in that market. So like we are early, but you can have buyers kind of walking away from stuff based on where the markets. So kind of unique. Like in HVAC, I think people are more open to just acquiring multiple brands in the same market. And roofing, that doesn't seem to be the case as much, where they get their brand and they're moving off to other markets. So the shrink if your market is already saturated with businesses that have been acquired.
Interesting.
What happens to companies when they get acquired, don't grow EBITDA? It depends. It depends what your deal is. It depends what you did is. If you're, and it depends perspective you're looking at from. For example, if you're a seller and you sold 100% cash and you walked away from the business and don't really care about it anymore, like nothing happens. Nothing happens. But I mean, a lot of owners still care, a lot of people that are there. They might have equity still involved. So it just depends what's going on. I mean, I think what you private equity makes plenty of mistakes. I'm not saying blameless. I'm not saying they're perfect at running all businesses, but their goals are usually rooted in the right place, which is we're trying to make this overall business more valuable in the future than it is right now. And that might mean we have to make tougher decisions now in the future, but they're a business that is much stronger in the future than it is right now. So I don't know what would ultimately happen. Again, if you have earnouts, they wouldn't do as well if you were tied to even went down. So it's kind of it's really situation specific, but I don't know. Again, depends on the deal structure, your deal, and your involvement, and what you care about. But you're going to have people trying to find ways to make it grow. I don't know. That was tough to answer without more context.
So it's like where like Russ, they kind of bought it for the real estate and they're trying to just gut it, right? Like the
Yeah,
roofing, they're
yeah,
trying
yeah.
to get
Yeah, I mean that's the only way they make. I mean, Toys R Us, like they probably bought it knowing this is a viable. Like we're still safe if this, then we're like it's not a good outcome, but like our money is still safe. In roofing, there's only one outcome here, and that's this. These businesses have to grow because there's no assets, there's no real estate. These businesses have to grow to generate the return. So they're finding ways to get these things to grow and make them more efficient and scale them because that's the only way they can make their return. And they're smart enough to know that if nobody wants to be at their companies, those businesses aren't worth much. They know that the driver behind growth is being a place where employees want to be and can perform and see results. So again, not blameless, but their goals are usually still in the right place. I've been involved with private equity. Seems like accrual accounting. It seems like accrual accounting by a month and trailing 12 months. Yes. So quality of earnings is something that is done usually post LOI. It is very important. It is when the buyer essentially goes in and verifies and validates the earnings of the business according to their business practice, their accounting practices and accountants they trust. And that's kind of the end all be all EBITDA that they view as like truth for this acquisition. Because in the end, a lot of companies have slightly different accounting practices. And I won't say they can't trust them, but you never really know, which is why they send an accounting firm to perform that quality of earnings so that they can kind of that's what they really like. I'll say like believe in the end, and that's what they go to their investors with. That's what they go to the banks with and say, hey, this is what this business makes, and this is what we're going to do with it, and this is how much we want to pay for it. And that comes from providing a good accounting firm doing one of those quality of earnings report and digging into the numbers and coming back with their view after adjustments and normalizations to what it'll look like on the buyer's books, and that's
Yeah.
what matters.
And we're coming up on 6 o'clock here. I know you have another commitment coming up, so I don't want to hold you up too much longer, but I do have one more question for you.
Yeah,
Guys, if you have any other questions for William, did I invite you to the group yet?
I think so. I think I'm in there.
Okay, cool. I'll add you in there. He should be in there, so if you guys want to chat with him. But William, let's say that somebody's either interested about learning, hey, how do I scale my business via add-ons, or how do I sell my business, get out from it, make some money from it, and move on to the next thing? How would they get in contact with you, ask questions, etc.? Like, what's the best way for them to do that and learn more?
Yeah, for sure. Probably the best way is message me on. I've started to get more public and more open on Facebook, but trying to share content that's valuable for business owners or mainly roofers. So that's probably the best place to do it. My website's marconadvisors.com, and that's got my email and maybe I think phone number on there.
I'm grabbing your profile right now, by the way.
Yeah, but I'd say I feel weird saying, but that's where I'm sharing stuff most days that I'd hope is valuable insight for owners just to get smart and educated for when the time comes. But again, email also wpauly@marconadvisors.com is how to get a hold of me. And I often joke, while I do know roofing M&A, if you really want to scale your business, I can talk to you about it. But if you're looking for the blocking, tackling of the systems to implement training processes and building a referral machine, I would love to tell you I'm a stud roofing company, but I've actually never run one. So there are better people that be the nuts and bolts and an operational consultant for your business than me.
Jay, I just dropped the link there
Oh, there you go.
to
Cool. Thanks,
William's profile, so you should be able to grab that. Did I send that to everybody? Yeah, it did. Host and
I think
oh no,
so.
I just sent it to host and panelists. Sorry, give me one sec, guys. I only sent it to me, you, and Isabel Will. So let me grab that actual link. I had it up like 2 seconds ago. But yeah, guys, if you want to chat with Will, go ahead, add him there on Facebook. I'm gonna drop that link to all of you now. Sorry about that, to everyone, and then you should get that. So. Jay, that'll be in there if you want to grab that. I'll leave the Zoom room open for a few more minutes for you guys to grab that. Any final notes on your end, William, before I go into like just closing?
No, I think that's it. I mean, the most important, I think, for roofers, like, just be aware, try and get more educated and know what your goals are. That helps you decide if maybe you can get there faster, maybe there are different ways to get there, but it all starts with knowing what your goals are for the business. and then you can kind of work backward from there. But that's really what it starts with. So there you go. George, thank you.
Thank you, William. And for the rest of you guys on here, if you haven't already, William's in the group. I just dropped the wrong link again. But the Facebook group is, I gotta rename it, but it'll be the Roofing Success Series. I just dropped the link to it down below. We just broke 100 roofing contractors in there, so super excited about that. We'll be posting the recordings to this, and then all the experts that come on and talk are also in that group. So if you guys have questions, drop them there. And thank you, William, for taking the time to do this today. Again, everybody who comes onto the series does it 100% free of charge out of the goodness of their heart. So everybody, please give William a thank you in the chat. We can give a one for a thank you, a two for a no thank you. I'm just kidding. Only once. Give William a thank you, and then we'll call it a day there. Thank you, William. I appreciate you coming on today, man. It's
Yeah,
super
man, I
fun.
appreciate it.